this week, we're looking at money management and risk management, and I've called it the secret sauce because that's truly what I believe it is. I think this is where you succeed or fail as a trader, is in your money management and your risk management. You know, all of the other stuff, finding the right chart setups and looking for high probability patterns and all of that, it's all good and well. Those are helpful, but really where your trading will succeed or fail is in the money management and risk management department. And if ever you've heard of a trader who has lost a fortune, it's always because something failed in the risk management and money management department. It's as simple as that. So if you can get on top of this, you can get on top of your money management and your risk management, then you'll have a better than even chance of success. And as I'll show you towards the end of this webinar, you'll see that there's actually some very interesting possibilities if you're able to utilize risk management and money management correctly and be consistent in how you apply it. All right, so in terms of the bullet points that we'll be going through on today's session, we start with understanding how much capital you have to trade with, which is an important starting point. Then we'll look at setting your maximum risk per trade and just understanding what it means in terms of risk, because some people don't always actually know what I mean by risk, so I'll flesh that out a bit for you. Calculating your position size on a trade, very important concept. Then managing your overall portfolio risk, which is also important. And then finally, the power of compounding small wins, which I think you'll probably find pretty almost mind-blowing. When I do it, it blows my mind. But you know, the power of compounding small wins is something you can't believe how powerful it can actually be if you get it right. So let's start with this idea of understanding how much capital you're trading with. And I guess this is a starting point. How much capital do you have to trade with? That is the question you should be asking yourself as a starting point. And you need to treat your trading like a business. So as if you were going into any other business, you've got a certain amount of capital that you're able to start with to fund your business with. And you know that that's kind of the boundaries of where you can move and do things within your business. And it's the same with trading. So know what your trading capital is. And also know that it shouldn't be a bottomless pit that you just keep on throwing money into. You almost need to define what your trading capital is and then work with that number and use that to try and create your growth as a trader. An important concept that I always also like to stress in this regard is that I view trading very differently to investing. And if I can give a brief breakdown of the two, I suppose investing, first of all, it's more of a longer term thing. It's somewhat more passive. Your analysis tools will be things like growth rates and PE ratios and dividend yields and industry trends and that stuff. Those are the things that move the needle over the long term. And those are the things that you're going to take into consideration when investing. And when investing, typically you'll invest in underlying shares. It won't really be derivative instruments. It'll be physical stocks or spot equities. And as I say, it's relatively passive in nature. On the other hand, trading is more short-term oriented. You would typically look at technical analysis to do your analysis, to make your decisions, which is what we've done so far in this course. You'll use derivative instruments in trading. So you could trade futures, you could trade CFDs, sometimes Forex, if that's your thing. They're all leveraged instruments though. And because they're leveraged, you need to be a lot more strict and vigilant on your risk management and money management. And it's more active in nature as opposed to investing, which is a bit more passive. So I always like to make the metaphor that investing is a bit like marriage. Yeah, you're in there for the long term. You see it through the ups and downs, and trading is more like dating, where I suppose it's more exciting, but if it's not working for you, you move on and look for the next trade. So those are the ways I differentiate it. So coming back to this point about trading capital, you need to decide how much capital you've got in your trading business, right? And don't muddy the waters between the capital in your investing versus the capital in your trading accounts, right? That's the first point. The second point there is that many traders just don't know how much capital they're actually trading with. They don't trade according to their account size. They either trade too big, as I've written there in big bold letters, or they trade too small in small little letters there for their account size. In my experience through the years of dealing with retail traders, I find more often than not, people trade too big, they're too aggressive, and that's when things can go wrong. And of course, if you're trading too small, well, then you just don't move the needle. And it's kind of important to try and find the right balance between those two. And that's what I'll try and teach you today. So the starting point for this lesson is knowing how much trading capital you've got, knowing how much you're trading with. And for the purposes of this lesson, I'm going to assume that all the examples I show you, you're trading with an account value of $20,000. Okay, so let's move on. Now, the next question after this is, once you've decided how much trading capital you have at your disposal, and I'd implore each of you to think about this while we're talking right now. How much capital do you have to trade with in your trading business? And once you've decided what the answer is to that, then ask yourself this question: how much of your capital are you willing to lose on an individual trade? This is a very important question. And I always ask it at this point in the course. How much of your capital are you willing to lose on an individual trade? So let's think, for example, you find a trade, you've spotted an opportunity, you think this looks like a good trade, I'm willing to put it on. At the end of the day, we are playing a probabilities game here. That's what we do. You've done your analysis, you've done your homework, you're putting on a trade, and you're taking a bet that your analysis is right. If it's wrong, which is a possibility, of course, how much would you be willing to lose to find out whether you're wrong or whether you're right? Now, we're not in a physical classroom environment, but typically I would go around the class at this point in time and ask individuals, how much do you think? What would you risk? You know, if you've got $20,000 in a trading account, would you be happy to lose $1,000 per trade, $2,000 per trade? What's the number? Right. Now, I've deliberately left the bottom of the slides blank for this point because I want you to think about it before I give you what I believe to be the correct answer. What is the right amount of money that you would be willing, what's the correct percentage of capital that you'd be willing to lose on an individual trade? Think about that just for a second. Right. And there's the answer. This is the generally accepted answer, is that you should not lose more than 2% of your capital on an individual trade. And that's a maximum, right? It doesn't mean you have to always lose 2% when you're wrong. It can be less. It can be 1%. It can be 0.5%. I've certainly found over the years that as I've gotten older and maybe wiser and somewhat more risk averse, my number has come down from 2% to 1% to like 0.5% nowadays. And maybe it's just a function of being older and wiser and having more to lose and more responsibilities and so on. But the generally accepted rule is that you should never lose more than 2% of your capital on an individual trade. So what that means is that if you have $20,000 in your trading account, which is the example that we're always assuming for this session, 2% of that number is $400. So it means that if your trade goes wrong, you will lose $400 and no more. And the nice thing about losing only 2% of your capital on a trade when you go wrong is that you still have 98% of your money left afterwards, which is still a healthy chunk of your capital, right? You're not likely to want to cry yourself to sleep at night if you've lost 2% of your capital. However, if you've lost 20 or 30% or 40% of your capital on an individual trade, well, then you actually might be inclined to want to cry yourself to sleep at night because it's very difficult to come back from that. And you need to really do pretty well to recover from such a hefty drawdown on your capital. In essence, I mean, if you think about it, losing 2% of your capital you could get 50 trades wrong in a row before you've lost all your money. And that's highly unlikely. All right. Especially if you're looking at high probability trading opportunities. Note also what I've said at the bottom there, that this is the risk that you assume on an individual trade. It's not the nominal value of a trade. So what I'm saying here is it's the amount that you would actually lose when you put a trade on and it goes wrong or it gets stopped out. It's not the amount of the value of a trade. Okay. And I'll show you this in some examples in a moment so that it becomes a little bit more clear to you. Now, the next important point is calculating your position size. And we tie this all back to that capital at risk. So there you've got the formula. It's pretty straightforward. Your position size should be the capital at risk, which, as I said, is 2% of your capital maximum, divided by the risk per share. And where the little asterisk there says the risk per share is the difference between your entry price and your stop loss. Right? That's the risk per share. It's best illustrated with examples. So let's get straight into an example where we can talk about this and actually unpack it. Now, for those of you that were on the webinar last week, I mentioned that Netflix was looking quite interesting as an example of a stock that was illustrating polarity, where the previous resistance becomes support. And at that stage, we were right down here near that $250 level on Netflix. And if any of you, in fact, acted on that, you would have done quite well in the last couple of days, because the price has now rebounded all the way back up north of $300 a share. So there's been quite a nice gain to be had there if you had have bought Netflix off that support level that I mentioned last week. Now, let's assume you had have done a trade here. And this is what it would have looked like in terms of the methodology that I'm referring to here when it comes to position sizing. So let's make the assumption that you had waited, you'd seen that the support level at $250 had held, price had pushed up, and you got involved there at $260 because you're now confident that the support has held, it's turning up. So you're in at 260 and you put a stop loss down at $245, which is basically below the lowest point of that reversal candle down there when it's touched the support line. And we'd look for a target up to $300 to go and revisit that prior high that we had seen in October. Now, the red and green blocks there illustrate the risk to reward ratio. So the risk is the difference between your entry price and your stop loss level. So that means your entry price is $260. Your stop loss would be $245, implying that your risk per share in this case is $15 per share. Right, and then the upside is the difference between the target, $300 and $260. So you've got $40 per share potential upside and $15 per share downside. That's quite a good risk to reward ratio. So if we run it through the calculation to work out our position size, these are the crucial numbers that we need to look at. So if starting point is the capital that you've got at your disposal, it's $20,000. Second point, 2% of risk, 2% of capital at risk is $400. We're going to be a buyer at $260, a stop loss at $245. That means our risk per share is $15 per share. Now, put it into the formula. You take your total capital at risk, which we said is $400. Right? That's how much we're willing to lose if the trade goes wrong and it gets stopped out. Happy to lose $400 if that's the case. And we divide it by the risk per share, which is $15 per share in this case. And you do that calculation, it gives you a number of 26 shares or 26 CFDs if you happen to be trading CFDs. Right. Now, in this case, the trade worked out beautifully, which is cool. It's always obviously nice when that happens. And the profit, had you sold out at your target level here, is $1,040. Of course, I'm simplifying it. I'm leaving out transaction costs and buy-sell spread and all of those sort of things just for simplicity. But there and thereabouts, you could have made $1,000 odd on this trade. With the fact that knowing you, if you had have been wrong, if the share price had continued south, well, then you would have been stopped out and you would have lost only $400. Okay. But as it turned out, this worked out. You made $1,000 just over $1,000 in this case. So your risk to reward ratio is 1 to 2.6, which is quite a nice risk to reward ratio. And the point I want to make here is coming back to this notion of understanding what does risk mean. It's the notional value of the trade is $6,760, but the actual risk is $400. Okay, so I want to stress this point because I've found in the past a lot of people who come on my courses will say, yeah, but if I only put 2% of my cash into this position, it's not going to move the needle. I mean, the share needs to go up 50% before I've even made 1%. No, that's the risk. This is the point I want to really stress to you. The risk is the $400. The risk means that's amount of money that you can lose if you get stopped out on the trade. Okay. The actual value of the trade will be 26 shares times by $260, right? In this case, that means your notional value of the trade is $6,760, but the risk is $400. So I hope that is clear. Right, and I've got another example here. This is now looking at a short trade, and this was in Tesla. And here we've got something I also showed you last week. It was a rising wedge pattern. Stock was generally in a downward trend, and it started to break below the bottom of that rising wedge. And the break below the bottom of the rising wedge also coincided with a break underneath the 15-day exponential moving average. So like I said to you in last week's presentation, a rising wedge is typically a continuation pattern in a downtrend. You'd look to sell short when the price breaks down below the bottom of the rising wedge pattern. So for illustrative purposes here, I've suggested that we went short at $225, which is the breakdown below the bottom of that rising wedge, a stop loss above the highest point in the wedge before the breakdown occurred. So I've worked it at $238 per share. And your typical move for a rising wedge is to see a move to the previous low, but I mean, often more than that, as the case was here. It did go below, but I've suggested that we'll look at a profit target of $200 on the downside. So what that means is you're looking for the price to move lower down to $200, and then you would buy back your short. And because you're going short, in other words, you're selling first, buying back at the lower price, the difference, your profit is the difference between where you sold short and where you bought back at the lower price. So again, run it through the calculation. We've got a capital at our disposal of $20,000. 2% of that is $400. That's how much we're willing to lose on a trade. We went short at $225. We use a stop loss at $238. Apologies, that is a typo there. That should say $238. Don't worry, the rest of the calculation is correct. The risk per share, therefore, is $13 per share. We take our capital at risk, which is $400, and we divide it by our risk per share, which is $13, right? And that gives you a number of 30 shares. So you could have shorted 30 shares of Tesla in this example. And if you were wrong, if the stock had moved up and triggered your stop loss, well, then you would have lost $400. But we were looking for it to move down to $200, and it did indeed do that. So therefore, you could have locked in a profit of $750 if you banked the profit at 200 on the share price. So it means that your risk to reward ratio here is 1 to 1.87, thereabouts, almost 1 to 2. And you always want to look for a risk to reward ratio of 1 to 2 or better, ideally. Anything less than that, you kind of it's not probably compelling enough to take the trade. You want a risk to reward ratio that is always stacked in your favor, where you can make at least 2 times more on a winner than what you're willing to lose on a loser. I try and aim for 3 to 1. So in other words, I try and make 3 times more on my winning trades than I lose on my losing trades. And sometimes you get that right. Sometimes you make lots more than that. And sometimes it'll be a little bit less. But on average, if I can get 2.5 times more or 3 times more on my winning trades than what I'm losing on my losing trades, then I know that's good. Then I've got an edge in my favor. And I know that if I can get more than 50% of my trades right, which is not that difficult to achieve, then that risk to reward ratio means that I should be consistently making profits on my on my trades based on that. Right. And again, just note the point over here. The notional value of the trade is what I've got at the bottom there, and your risk is $400 per share in this case. So just be aware of the difference between the notional value and the actual risk. Right. The next question then is managing your overall portfolio risk. Because this is the next question a lot of people will ask me. They'll say, okay, fine, I understand you risk 2% of your capital on one trade, and if it goes wrong, you lose 2%, and that's not the end of the world. Cool. However, we don't usually have only one trade on. We usually have a couple of trades on. What happens if you've got 10 trades, all at 2% risk, and they all get stopped out at the same time? Suddenly you've lost 20% of your capital. Like, that's a big drawdown. How do you mitigate against that? So as part of my trading playbook, I also take into consideration the overall portfolio risk. So what I have said here is that ideally, I prefer to have a maximum of 6% of my total portfolio at risk at any one time. So if everything goes wrong all at the same time, all my trades get stopped out at once, I don't want to be losing more than 6% of my account on it at any given time. Okay. Now, this is, it should be a relatively low probability thing that all your trades get stopped out at once, unless you have a great deal of correlation between the trades that you're in. If you have, for you, for example, you're long of Goldfields and long of Harmony and long of Anglo Gold and long of, the gold price, well, then you've got a lot of correlation between all of those trades, and you run a far greater risk that they all get stopped out at once. So I wouldn't advocate that type of trading where you get that type of concentration risk. What I'd rather suggest is that you have trades that are somewhat uncorrelated, or maybe in different areas of the market. Perhaps you have a couple of longs and a couple of shorts. And the other thing is what I've mentioned at the bottom here, is that you should have trailing stop losses on your open trades. Once you're in a trade and it starts to work to your advantage, what you want to do fairly quickly is actually ratchet that stop loss up to your entry point so that you don't actually have any risk on the trade. It almost becomes a risk-free trade. And then if it happens to go down and below your entry point, well, then you get stopped out. You haven't really lost anything. Okay. I know it's a difficult thing to do because sometimes noise can mean that you get stopped out by short-term volatility, and that can be very frustrating. So trying to balance trailing stop losses without getting stopped out unnecessarily is a little bit of a trick in itself. But the point that I'm trying to make here is that by using trailing stop losses, you can also protect your overall portfolio risk, because you're effectively limiting the risk on certain individual trades, and that in itself will protect your overall portfolio risk. What I've also shown here is that your overall trading setup with the total number of trades you've got, it can vary. I've mentioned looking at 2% risk per trade, which is a maximum. Just keep that in mind. It's a maximum. It doesn't have to always be 2%. It can be less. So the way I would view it is like this. If you're risking 2% of your capital on one trade and you don't want to lose more than 6% at once, well, then you can have 3 trades open, right? 3 trades of 2% risk at once. That's kind of your limiting factor as a general guideline. If you reduce your risk per trade to 1.5%, well, then now you can afford to have 4 trades open at once. If you reduce your risk further down to 1% of your capital, well, now you can have 6 trades open at once, and so on and so forth. Okay, and you can play around with that. The point being that you don't want to have your overall portfolio risk at a ridiculously high level in the event that your overall portfolio all gets stopped out and everything goes horrendously wrong all at once. So that's another important consideration to keep in mind, in terms of managing your broader risk and managing your overall portfolio risk. Now, the power of compounding small wins. This is where it gets interesting, and this is where I find this quite mind-blowing at times. Just try and I'm getting a thing up on my screen here that is frustrating me. Anyway, never mind. What I've got on this slide over here is an example of what is possible with 100 trades. And I apologize that the writing is so small on this slide. It's almost like the writing on the disclaimer slide at the end of this presentation, which is so tiny, you need a magnifying glass to read it. So I do apologize, but I had to put it all on here just because I'm trying to make a point. The point is this. Let's assume you've got the year ahead of you. You decide in the year ahead, I'm going to commit to doing 100 trades, and I'm going to be diligent with each one of those trades in terms of making sure I don't lose more than 2% of my capital. I'm starting with $20,000, as in the examples we've used before. The wins and losses that I've put into the spreadsheet are randomly distributed, right? So it's not win, loss, win, loss, win, loss, win, loss, because that's not how the market works, unfortunately. The market tends to cluster. So you'll find you have win, 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 lose, 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 win, lose, win, lose, win, 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 lose, 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 etc. What you want to be careful of is the clusters, and especially the losing clusters, because that's where it can all go wrong. When you have 6, 7, 8 losing trades in a row, right? And if you're losing too much of your capital on each individual trade, that's when it can all unravel and go horrendously wrong for you. The market theoretically is always 50-50 because the share price is either going to go up or down. So you theoretically should have 50-50 odds all the time. But as you'll know from a coin flip, it doesn't always work at 50-50. There are times when it clusters where you'll have several heads in a row or several losses in a row, okay, or several heads or several tails in a row, should I say. And it's the same in the market. So you have to take into account the clusters. And that's why I've said here that the wins and losses are randomly distributed. On your losses, you're going to lose a maximum of 2% of your capital, which is $400 at a time on an individual trade. I've been conservative here and said that your average win is going to be twice as big as your average loss. Okay. I think that's conservative. I think you could probably aim higher than that, but for the point of being conservative, let's go with that. So your wins are twice as big as your losses. So you're going to lose 2% of capital on your losing trades, but you're going to make 4% of capital on your winning trades. Then I've gone and made another conservative assumption, and I've made the assumption that you're only going to get 40% of your trades as winners, right? And 60% of your trades as losers. Now, I believe that if you're following a high probability trading methodology and you're following the types of analysis methods that I've taught in the previous lessons before this, what you're doing there is you're actually skewing the odds in your favor to try and give yourself a higher probability of being successful. Hopefully, you should get more than 50% of your trades as winners. You know, ideally, you want to try and be getting closer to 60% as winners and 40% as losers. But let's be conservative for the purposes of this exercise and say only 40% of your trades are winners and 60% of your trades are losers. Now, what I've done in the spreadsheet, if you've got good eyes and you can see these numbers, right? I've started with $20,000 and I've numbered all of the trades. We've done 100 trades, okay? The losses are set at minus $400, which is 2% of your capital, and the winners are set at $800, which is plus 4% of your capital. As I said, the wins and losses are randomly distributed. So there are examples where we've got clusters of losses and clusters of winners. I've included some fairly bad losing clusters here, like over there. There's 8 losses in out of 10. Effectively, and down here we've got I think that was 7 or also 7 or 8 losses out of 10 in a row there as well. And then we've got a few winning clusters, but by and large, I've actually skewed the clusters in favor of more losses than wins. Okay. Now, the running total gives you the answer here. As you go through this year and you proceed through the 100 trades, what you get at the end is $28,000. So you've made 40% return on your $20,000 of starting capital. And that's at the end of the year, assuming you've only taken 100 trades. I think that's a realistic number of trades to take. Are there 100 high probability trades per year available in the market? Absolutely. There's more than that. But let's work on 100 and assume that you go into the year, committing yourself to 100 trades, 100 high probability trades. And on each of those trades, you're going to be absolutely disciplined about never losing more than 2% of your capital and trying to come out with an average win over the course of the year that is 2 times bigger than what each of your losses are. And you know that only 4 out of 10 trades are going to be winners and 6 out of 10 trades are going to be losers. Well, if you can get that right, based on the numbers I've shown you here, then theoretically you can come out at the end of the year with a 40% return. Okay. Does that sound realistic, or does it sound like pie in the sky, like I'm talking nonsense? Obviously, you can't answer me because this is a one-way conversation. You're just listening to me go on. But I mean, ask yourself that question. Do you think it's realistic? Personally, I do. I'm not in the game of selling unrealistic, unattainable dreams. I certainly hope that the profile I put out there through all of the work that I've done over the last 2 decades has always come across as honest and reputable and realistic. Okay. I don't think this is unattainable. In fact, I think it's very achievable, but there's a lot of complications to achieve this. It requires you to be very disciplined. It requires you to be quite focused. It requires you to be on top of your emotions, to not make silly mistakes, right? So yes, this is achievable. In theory, absolutely it's achievable. In practice, it is a lot harder than what it seems as I've written it out here. And have I done this consistently? No, I haven't. Right? As a professional trader with over 2 decades of experience myself, I'm still striving to try and achieve this type of consistency. I've achieved it in a couple of years, but I haven't achieved it every year. Okay. And my ideal is to get to a state where I can actually continually reproduce these types of returns year in and year out, year in and year out. Maybe I'll get there someday. So the point is, I know it's not as easy as it seems, right? But it is achievable. Then here we've got what the payoff would look like. Effectively, this is your profit and loss graph of that spreadsheet that I've just shown on the previous slide. 100 trades, $20,000 starting capital, 60% losers, 40% winners, random distributions, losing 2% on your winners, making 4% on losing 2% on your losers, winning 4% on your winners, etc., etc. You can see how that profit and loss equity curve gradually climbs into the top right corner of the page, notwithstanding the fact that you've lost on more trades than what you've won. But because you're winning bigger than what you're losing, you've got an edge, and your equity curve gradually climbs up into the top right-hand corner of the page. Now, here's the next thing. Let's assume that you've come to the conclusion that that exercise is achievable. You do 100 trades in a year, like I've said, sticking to the discipline of losing 2% and making 4% on your winners, etc., etc. Everything we've just discussed. And you can do that consistently for 10 years in a row. And each year that you start, you reset your account. So, in your first year, You take your $20,000, you make $8,000, which is the 40% return. You now start the next year with $28,000, right? So now you compound that. The following year, you're now going to up your risk on each trade. So that 2% risk becomes a slightly bigger nominal value, but it also means that your winners become a bigger nominal value. So now 40% in the next year is suddenly $11,000, right, off of your starting capital. So that means that after 2 years, you've come out with nearly $40,000. So you've almost doubled your starting capital after 2 years. And so it goes, and so it goes, making 40% extra each year, year in and year out. Look what happens after 10 years, $578,000 off a starting capital of $20,000. Okay, so compounding that for 10 years, your money grows 29 times. Is it possible? That's the $1 million question. Well, theoretically, yes, it is. This is basic maths, and it's not complicated. This is not rocket science. Theoretically, this is possible. Practically, it's very hard to do. And the question I ask you is why? Why is it hard to do? Because in reality, in theory, this is actually very easy. Yeah, the numbers are there. They don't lie. Why is it hard to do? And I'll tell you why. It's because we're all emotional creatures, and trading is one of the most emotionally taxing things you'll ever try and do in your life. So to try and achieve these types of returns and try and replicate what I've put here on a simple spreadsheet is actually very difficult to do when you throw in your human emotions and the fact that you don't get your results straight away. I think that's half the problem with the market. You often have to wait a few days or even a few weeks before you see the result of a short-term trade. And during that time, there's a lot of potential for noise to come into your head. You read the news, you listen to other people's opinions, you look at Twitter, and you get all of these conflicting things coming into your face, which makes you doubt yourself. And those doubts make you want to snatch at profits too quickly, or make you potentially want to not cut a loss when you should and ride your losses too much. Or alternatively, maybe cut a loss too quickly before it got to a stop loss, only to then find that the trade actually would have worked. There are all these different things that come into play. It's all about fear and greed. And that's an old saying, markets are driven by fear and greed. We know this. Fear of loss, fear of losing a profit, greed, wanting to make your money faster than what is realistically achievable, or greed in the sense of wanting to snatch at profits rather than trying to let a good trade run on a little bit so that it can make a little bit more for you. Greed in the sense of not sizing your positions correctly, being too aggressive, too greedy. All of these factors come into play and are, at the end of the day, negative components of our trading that effectively hold us back from achieving what is really quite a simple mathematical equation, like I've shown you here on the spreadsheets. If you can get on top of your emotions and almost trade as if, the money doesn't matter, and I say that cautiously, if we were to do this as a theoretical exercise, I bet you we'd all be able to do this. But when there's real hard-earned money on the line, your money, suddenly the emotions become very different and difficult to control. That's why it's difficult to achieve this. But it is possible. There's no doubt in my mind, it is possible to achieve this. But it entails a lot of digging deep and being in control of your emotions and your discipline to achieve it. So here's the challenge to you. This is the last slide before I take some questions. Set out to try and do this. Set out to do 100 perfect trades over the next year. Okay. What is a perfect trade? It doesn't mean that every trade is a winner. perfect trade is where you stuck to your strategy, where you set a stop loss where you'll only lose 2% of your capital on the losing trades, and you'll make an average of 2 times or more your capital on your winning trades. A perfect trade is where you stick to the strategy, no matter what the result is, be it a loser, be it a winner. A perfect trade is where you stick to your strategy. Okay. So like I said, aim for a maximum of 2% loss on your losers and a minimum of 4% gain on your winners. See if you can achieve that 40% winning percentage on 100 trades, like I've just shown you in the spreadsheets before this. Can you do it? Well, I'd love it if someone can. I've never seen anyone do it, not in all the years that I've been presenting my high probability trading course, which is 10 years now. After every course, I ask the class, do this, go and try and do it, and come at the end of the year and show me the results. If you can do it, I'll buy you lunch. No one's ever come back to me. So either I'm a lousy teacher, or people just don't have the commitment and the discipline to the task to do it. And I hope it's the latter. Many years ago, I had a guy in Durban who he was convinced he was going to be the first person that would achieve this and come to me and show me that he had managed to do it. And he kept in contact with me. You know, every week or two, I'd get an email from him and he would update me on how he was doing. And it was looking good. For about 6 months, he was on track. And I thought, this is impressive. Maybe this is going to be the guy who actually comes and generates this and does it. And then I didn't hear from him for a few weeks. So I thought, wonder what's happened. I emailed him. I said, hey, what's going on? I haven't heard from you. You've been quiet. And he said, yeah, you know, Garth, I lost my discipline. One trade, and I lost it all. All my winnings of 6 months before this, I added to a losing trade. I got a bit greedy. I didn't stick to the stop loss, and it all just blew up in my face. One trade. And that's the reality. We're always just one trade away from blowing up an account. It's difficult, but it is possible to achieve these kind of returns. I firmly believe that it is. As I say, I've accomplished it in some years. I've seldom managed to string back-to-back years where I can achieve this. It's still on my bucket list to do this. And I know what it's required. It's discipline. It's, being on top of my emotions, etc., etc. It's not as easy as it sounds, but it is possible. All right, so what have we done? We've done 40 minutes of me rambling on and talking. I hope you found that interesting. There's the disclaimer with that incredibly small writing that Rand Swiss put up there. If you feel like reading it and you've got your magnifying glass handy, go and get it and you can read that. But at this point, I'll take questions and I'll answer as many of them as I can. Hopefully, try and keep the questions relevant to the topic that we're talking about, if you don't mind. I see there are some questions here in the questions box already. So I'm just going to go through them one by one and try and answer as many of them as I can. Okay, so anonymous, you always, if it's the same anonymous attendee, you always ask lots of questions, but you ask good questions. So that's great. Keep them coming. You've asked the first question. Some global stocks have a minimum quantity of 10 shares. How would you calculate the risk? Okay, so again, it's the same. It depends, of course, on what the share price is and how much you have in your trading account. You know, if you're trading 10 shares of a pretty high value stock, well, then that might just be out of your universe if it's too big for your account size. Okay, so just keep that in mind. If it's too big, well, then you need to be cautious and not go there, because you don't want to oversize your position in that sort of instance. Then I would just avoid it and look for another opportunity elsewhere. Then you said, hi, do you typically wait for the target to be reached, or do you sometimes close out earlier in profit before the target is reached? Well, the truth of the matter is I often do snatch at my profits too quickly. because I think that's human nature. We see that winner, we think, that's nice, it's close enough to my target, I've got the rump of it in the bank, maybe I'll take it. And often then you realize you've taken the profits too quickly. Knowing when to sell is the hardest part of trading. I'll say it again, knowing when to sell is the hardest part of trading. Stop losses, easy. I can do that with my eyes closed. Getting a good entry, I found that over the years, I've become quite good at that. Knowing when to sell is the hardest part of trading, because you either sell too soon and leave money on the table, or you wait and you overstay your welcome and see your profits evaporate. It's tough to know exactly when to sell. So, my answer is yes, I often do take profits too quickly. And I guess in many ways that helps me to be profitable, but it also means that I'm not achieving as much as I could as a trader, because I tend to bank profits too quickly a lot of the time. And that's also frustrating. Okay, Anonymous again, is trading a feasible option to make a living every month? This is such a great question, and it's a question that I get asked often. And it's such a complicated question to answer. Is trading feasible, a feasible option to make a living every month? Yes, it is. However, and a big however here, there are a lot of things you have to have in place in order to do that. And you also need to remember that trading, your profits in trading they don't come in a straight line. This is not like a cash machine. It's not like an ATM where you can just go and draw money out of it every month and know that it's going to give you money consistently. You're going to have months where you lose money. That's the reality. And you're going to have months where you make money, and occasionally you make a lot of money. Your returns in trading are lumpy. That's been my experience. You can have a generally rising equity curve, but it doesn't go up in a straight line. It goes up and down, and sometimes down a bit more, and then up, and sometimes up a lot, and then sideways. So it never goes in a straight line. There are a lot of other things that you need to have in place. So, for me, being properly capitalized is very important. Another thing is, I think having no debt is important. Having a good, sound, solid equity base underneath you with no debt is very important as well. These are all considerations. You need to have experience. If you can't make money as a part-time trader, what makes you think that you're going to suddenly make it as a full-time trader? You need to be showing consistent returns as a part-time trader before you can become a full-time trader to make a living from trading each month. Right? For me personally, do I trade for a living? No. The reason is because trading for a living, knowing that your ability to put food on the table and pay your kids' school fees and medical bills and all of the other things that we need to pay for every month, if you are dependent on trading profitably to meet those expenses every month, it is incredibly pressurized. You put an inordinate amount of pressure on yourself if you think that you're going to depend on your trading profitably to do that. So for my purposes, I have all these other diversified revenue streams. I have my Traders Corner website. I have my online course, which I've spoken about. I do some work for other brokers. I do things like this webinar, which Rand Swiss are very kindly paying me to do, and various other things that I do in order to earn a risk-free income each month. And that pays the bills. And what that means is that I don't have the pressure of knowing that I have to trade profitably every month to make a living. It takes a lot of the pressure off. And as a result, I can trade properly, and I'm not forced to trade. I trade when I see opportunities that are there and I take advantage of them. So for me, my trading is really there to try and grow my asset base and grow my capital rather than to try and live off the proceeds every month. If you're coming at trading, trying to do it for a living, just know it is bloody difficult, very difficult. I do know of people who do it and that do it successfully for a living. But let me tell you, I know they have their emotional ups and downs, and sometimes they sickle. All right. So yes, it's possible to make a living from trading, but it's not easy. It's really not easy. So please be very, very careful if that's your intention. Okay, then also still anonymous. Would you consider subscription-based services from reputable companies, high probability trades? Well, yes. I mean, I run one. My traderscorner.co.za is where my colleague and I, Andrew Todd, he's my colleague of the last 15, 17 odd years. We publish analysis, we publish strategies, which we believe are high probability trading strategies, and we're doing the homework for you. So yes, I think there are some good services out there. I like to think ours is one of them. There are others as well. But also just know that what we're doing is, following someone else's analysis and ideas is not where it ends. I liken it to being like, we can be like your caddy on the golf course. I can tell you on the golf course, okay, the hole's 150 meters out. You need to hit a 9-iron. There's a bit of wind, coming from the left, etc. You still have to hit the ball at the end of the day, right? I'm the caddy, you're the player. It's the same with what we do in terms of providing analysis to our clients. We'll give you the guidance. We'll show you what we think is a decent setup, but it's up to you as to whether you trade it. And then it's also up to you as to whether you size your position correctly, whether you obey the stop loss, whether you take the profits at the right level, et cetera, et cetera. So, we can get you some of the way there, but the decision and the ultimate success or failure is going to lie with how you utilize that information. And then some people say, I got 100 points in the trade today. What does that mean? Well, what that probably means is if they might be talking about the Aussie future, or they might be talking about some sort of an index like the Dow Jones or the S&P 500, where the index is denoted in points. All right, so that's probably what they're referring to in that situation. Then Rati said, thanks for an excellent presentation, and it was very interesting, honest, and an eye-opener. Oh, cool. Thank you, Rati. All right, Anonymous again, you've asked, at what point do you add to a winning trade? Very good question again. Is it over a certain percentage increase? So yeah, the idea with very successful traders is that they add to their winning trades. So when they're onto a good thing, they add to their position, they make it bigger in order to try and maximize the winner. And they'd use that in a what's called a process called pyramiding. So think of a pyramid. At the base, it's the biggest, then it gets smaller and smaller as each layer progresses. So in other words, you start with your biggest position initially, then as the price moves in your favor, you add an incrementally smaller position at each layer in the pyramid. The thing about that is that if you then get stopped out on your trade when it's immediately not working, well, then your position is the smallest at that point in time, so your loss is likely to be small. And if you're correct and the market continues to move in your favor, well, then you're going to be making money on a bigger position. So I do this with my own trading, but again, it's not the easiest thing to do, and especially when it comes to short-term trading. And when I say short-term trading, I'm talking, over a couple of days to a couple of weeks. Adding to winners is tough because what it means is that you always invariably have to ratchet your stop loss up. But it also means that you become more of a victim of short-term volatility, and you can get stopped out quite quickly by short-term volatility if you're tightening your stop loss up too much. So where I find adding to winning trades is a useful way to make money is more with medium-term trades. If you've got a trade where your view is to hold it for 3 months or 6 months, and your target on that trade is for a move of 20 or 30% in the share price, on those kind of trades, it's easier to add to a winning trade and then sort of monitor it and tighten your stop loss up a little bit, as opposed to trying to do it with an ultra short-term trade or even an intraday trade. Then how do you deal with discipline? Anonymous has asked, how do I deal with discipline? Yeah, it's a good question again. I think there's a lot to be said for having discipline in your life overall. If you're a disciplined person in general, then it's probably easier to try and have discipline in your trading. So in my life, I have some fairly rigid routines. You know, I get up at a certain time of the day. I have a certain morning routine that I do. I have a deadline in terms of having to publish analysis for my Traders Corner website. All of these things are discipline. I'm quite disciplined with how I spend money and record it and all of this. I'm disciplined with going to gym and disciplined with what I eat, etc. All of that, I think, feeds into your overall discipline as a trader. And if you're disciplined in your life, probably it's easier to be disciplined in your trading. What I also have found over the years is I have my rules, my basic trading rules, written down. It's called my playbook. That's something we're going to talk about next week. And I try and remind myself of those rules all the time. What I used to have was actually have them on the wall in my office, stuck up there. And I'd read it to myself every morning as part of my morning routine, just to remind myself the rules of the game, almost to enforce that discipline. I think over years and years and years of doing that, I don't need to read it to myself anymore. I kind of know what the rules are, and that discipline has been enforced. And the other way to enforce discipline, unfortunately, is the hard way. Just try being undisciplined and see where that gets you in trading. You'll find that it very quickly pushes you in the wrong direction. And that is in itself enough of a incentive, I guess, to try and help you be more disciplined in your trading. Karen, you've asked stop losses and gap downs, how to manage the risk amount in this case. Yeah, this is also a good question. So a gap to the downside, or just a gap, an overnight gap, is where the share price of the instrument that you're holding opens at a significantly different level to where it closed yesterday. And there's a gap possibly to the downside if you're long. So your price was there yesterday, suddenly today it opens there. It's gapped down and it's gapped right through your stop loss. It can happen. Usually it happens because there's news out, some unexpected event or something that wasn't anticipated by the market. And that's what can happen now. And it's frustrating when it happens. And it does happen. And the reality is none of us are going to go through our trading life without encountering some sort of gap risk at some point. How do you deal with it? Look, if your position is sized correctly, such that you're risking a maximum of 2% or 1% of your portfolio, and it gaps sharply through your stop loss, okay, you probably might end up losing more than the 2% that you were comfortable to lose. But it's still unlikely to be a catastrophic loss because your position size is not going to be so enormous that it wipes you out, just by virtue of the fact that your position size is being calculated correctly. So, you know, it can hurt. You might find that in a really bad situation, you come out losing not 2%, but 5, 6, 7, 8% of your capital on that one individual trade if the price gaps against you. It's not nice, but it's not catastrophic. You can come back from that. And also know that that is more the exception than the rule. And when it happens, look, it's one of those things. It's happened to me a number of times. It's very frustrating. But as I say, if the loss is not catastrophic, you can come back from that quite quickly. Fabian, you said, can't you take out, say, 50% of your profits in a trade, i.e. sell out some of your position to secure some profits as a way to mitigate against the loss? Yes, you can. You know, and if that's part of your process, you can. You can exit half your trade to pay yourself for a good trade, for a good entry. And you've then put some money in the bank, and you've still then got 50% of the profit of the trade on to try and extract more out of that trade. Absolutely, you can do that. You know, I think, again, this just comes back to a point of, is that part of your strategy? Is it part of your playbook? And playbook is something we'll talk about next week. To bank half profits at a certain level. Yeah, fine. If that's the way you like to do it, there's nothing wrong with that. You bank some profits, you keep your ticker moving forward. But just know that by doing that, you are automatically going to sort of cap your upside. you're not going to be able to extract the maximum out of your winning trades when they come around. And, I suppose in a case like that, it's like saying to yourself, if you're in a rugby match, instead of getting 5 points for a try, you're only going to give yourself 3 points for a try. Your score's not going to move higher that very quickly in that case. Right. So, but yes, I mean, there's nothing wrong with doing that if it's something you choose to do. Okay, Luke Simmons, you said it's not rambling on. Garth, thank you. You're an incredible teacher, very kind, and you continue to inspire me to be a better trader. Thank you so much. Wow. Thanks, Luke. Would you say that keeping to your strategy and being disciplined can sometimes cause a pernicious attitude when it comes to learning? Gosh, I might have to Google what that means, Luke. Where is the line between learning and holding fast to your strategy? It's a good question. Look, I think as a start-out trader, if you're early in this, then stick to the rules, right? Be diligent to the rules. Once you've done that enough, you'll have learned a bit more about how markets work and where you can maybe bend the rules a little bit or be a little bit flexible, because that is something I've noticed in really successful traders, is they are diligent, they do stick to the rules, but they also know when to bend the rules, when to be a little bit more aggressive to extract the maximum out of a good trade. Okay, there is an element of gut feel. There is somewhat of an art to trading successfully, which comes with experience. Okay, and I guess you've got to just give yourself the time to learn that. So start out by being vigilant with the rules, stick to the rules, be disciplined. And then over time, as you become more proficient and you become more familiar with the movements in the market, you will gain that gut feel over time. And then you can start to be a little bit more flexible, albeit, around sticking to the rules still. All right. Fabian, you said, in your example, you used $20,000 to practice. Would $1,000 be sufficient? Or would you be eaten alive by transaction fees? Yeah, I think you would be eaten alive by transaction fees, to be honest, Fabian. There's a point at which your capital in trading needs to be above a certain level in order to for it to make sense. If you're not properly capitalized, then it's very difficult to trade successfully. So I've had this question many times over the years where people come to me and they say, I've only got 10,000 Rand. Can I start trading with that? And my answer is like, no, I really don't think so. I think you've got a slim chance of being successful if you're so terribly undercapitalized. You need to have, a decent enough capital size in order for it to make sense. A, because you need to be able to overcome those minimum transaction costs. And B, you also need to have enough cash in the bank that you actually can bounce back a bit from those small losing trades. So, my answer was always a minimum of 6 figures. So in South Africa, that's 100,000 Rand minimum. And in the examples I've used here, $20,000, which I know is like 350,000 Rand odd. It's, it might be a lot for some people. But the point is, again, I go back to talking about trading and treating trading like a business. In business, you need to be properly capitalized to have a chance. If your business, no matter what business it is, if you're undercapitalized, your chances of your business failing are significantly higher. And it's the same in trading. So you do need to be properly capitalized in order to have a better than even chance of making success of this business of trading. Okay, Luke says, I think you've given me the definition of pernicious here. You've said, in other words, not being set in one's ways. So yeah, thank you. I've learned something without having to go onto dictionary.com. And I think I've answered the question as well, Luke. Yeah. Graham Sturley, thanks. You've said it's a great webinar. That's it. Appreciate it, Graham. You've always been a big champion of mine, a cheerleader. So thank you. And then Mark Watchhorn, Garth, when during the day do you tend to place your trades? Before the market opens, after trading, or any other time? Mark, no set rule really. It can be sometimes before, if I've got a specific level in mind. Sometimes during the day. It really depends. And I don't think that there's a hard and fast rule in my mind as to when to set your trades. The opportunities are there when they're there. So sometimes I'll put orders in before the market. I mean, right now is a good example. I've got some stuff I'm trying to do in the US market while I'm presenting this webinar to you. I'm not there to do it. So therefore I've put the orders in. They might have traded. I don't know. I'll check when I get off this call with you. And if they haven't, well, then I'll have a closer look. There's no hard and fast rule for myself in terms of when to put on the trades. All right. And that, I think, is okay. There's one more question from Navindra, and I'll answer this, and then I think we have to wrap it up because we've just gone a bit over the 1 hour. Does position size calculation also apply to indices, futures, and Forex? Yes, spot on. It absolutely does, Navindra. Your position sizing is very important no matter what you're trading. So whether it's futures, indices, Forex, all of these things, you have to calculate your position size based on the amount of money that you're willing to lose or the amount of money that you're willing to risk on each individual trade. Always. The answer to that is always yes. You always size your position. Doesn't matter what you're trading. All right. So that's it, everybody. Look, thank you very much. I've managed to get through most of the questions. It's been good. I've enjoyed this lesson based on the questions I think that you all have, because the questions were very much related to the topic, which I appreciate. Hope you found it useful. I hope you found it inspirational, because I do find this kind of stuff inspirational, what I've talked about here today. And I'll make it look easier than it really is, but it is possible. I know that.